Hi, this is Randy Finney with the Right Side of the Chart, and today is Thursday, January 7th, 2016. This video, I promise, will be a quick one. I just wanted to take a look at the market. Focused a lot on the Qs lately, the NASDAQ 100, because that has been the leading index. It's held, well, I should say held the market up. Every other index, as I mentioned the other day in the uh, U.S. equity market video, most other U.S. markets topped in early or in the middle of 2015. So, those markets are well off their highs. The Qs managed to push up. I think it was until November. And anyways, it's typical with any if we are about to embark on a bear market, or even if we're just looking at another big correction, you need to see those leaders break down. And so far, we've started to see some of those leaders break down. We've seen the Qs break down. I've covered this chart ad nauseum. This is a 60-minute chart of the Qs, but I just wanted to kind of give everybody a quick near-term look at it. What I'm seeing, how I'm trading, what to look for. This is the same chart posted this morning. If you're watching the video, you've probably already seen today's static post. These are the notes. We closed here yesterday. You can just see how well, and especially during corrections, for some reason, technical analysis works when the market's going up as well, but during corrections and pullbacks, I find it a lot easier to trade off support levels or resistance levels because you have so much past action to the left, especially as I mentioned in that video the other day. If what I just said isn't clear, when the market's making new highs, when the Qs was making printed new highs uh, back last year, you don't have any support levels, I'm sorry, resistance levels to look at. Really all you can do are go off trend line breaks and things such as this rising wedge pattern here that I pointed out. That played down for a nice breakout. Anyways, I won't go into this too much. Here's that consolidation zone where we traded sideways for a few months, at the end of 2015, all the way through the last few months of the year, pretty much the fourth quarter. And so as mentioned before, when we were up in there, I favored downside breaks. So you can see what's happened. Just a quick review. We gapped down below the trading range. We came back to back test it, failed. You can see that red candle. That means that we didn't even close back up in there. So that S1, T1 was the first target. It was actually, I believe that was posted way back here. That was hit. But either way, that S1 means first support level. And broken support becomes resistance, as we all know. So we went back up there. As expected, we got the back test, which was a great shorting opportunity. Even when we were down here the other day, I think on Monday, I mentioned if we got a back test, that would be a very objective level to short. With my expectation, we'd go down to the T2 level. We gapped down there yesterday, I mean, almost perfectly. And as is so often the case, the initial tag of support produces a reaction. So we had a reaction. It happened to go up to this S2 level on the chart, reversed, and came down yesterday to test that level one more time. Now, as I often say, the initial reaction or the initial tag of a support often produces the reaction. So even if I expect more downside, it's usually on the subsequent, whether you get a second or third tag, that's about it, and then that level breaks. And just like in a bull market in reverse, when you're in a bear market, or at least a bearish trend, still too early to say the Qs are in a bear market, but we're certainly in a downtrend. And as I covered most trends, even the intermediate term and some of the long-term indicators are bearish. But as so often is the case, it doesn't make it easy for you. So if you were a trader, yesterday you saw us bounce off this level, you didn't want to stay short. What happened today is we gapped down. In fact, in pre-market, we were trading, as I pointed out this morning, below that level. But as often I've seen and I pretty much expected, we would snap back up there. And if you really zoom in here, let's see if I can do that on this chart. Not while I'm rolling the video. Okay, yeah, I can zoom. I had the screen draw tools on, so that was overriding the chart. Okay, so this morning I changed these arrows because we closed here yesterday, pointed to a gap down here, and pre-market, like I said, we went slightly below there, giving, as I mentioned, active traders an opportunity to cover and or at least trail your stops. And what happened from there, we bounced up. Now I have these arrows drawn because from here, the best way to trade this market, in my opinion, is you look for reactions, especially if you're an active trader. Look for reactions off these initial tags of support or target levels. You can cover, you can reverse, reduce your position sizing, hedge up. It's up to you. And again, if you're a long-term trader, don't try to bother gaming these bounces if it's not your cup of tea. If you work a full-time job and you don't have time to closely monitor the market, I think you should get short and stay short until we see signs that this correction is most likely run its course. So as the arrows show here, ideally, and we may not get it, but ideally your next shorting op or add-on would be back at the T2 S3 level. Again, these should really be resequenced to say R, R2, or R3, meaning resistance, or just R. But just keep in mind, former support level once broken becomes resistance. So that would be an objective shorting area. Now, if we go much past there, you have these other levels ahead. And as I mentioned earlier today, somebody had pointed out in the trading room, I've talked in the past often about the OPEX ramps. Next week, next Friday is options expiration. So being that the market is pretty oversold in the near term, you can see the RSI down here. And we do have some potential divergence setting up. It shows a little better on the 30-minute chart. I'm looking at the 60-minute chart here. So it wouldn't surprise me to see this bounce go higher. Now, this is a wall of resistance right here. This former S1T1 level. We had the big, huge gap here. Gaps are very powerful areas, tops and bottoms of gaps that work well as support and resistance. Now we had reaction. As you can see, there's the bottom of the gap, reaction, a close reaction there, reaction there. So if we do get up there, then let's say, for example, you didn't have any positions now, but you wanted to get short. You could obviously short here, maybe a half position, and then add another position and bring it to a full position at that point. And you'd want to cover not too far above, somewhat. I always place my stop slightly above where the actual resistance level is. There's a reaction high there around 110.11, so that would be, if we got much above there, odds would be good that we would move all the way up to this resistance level here that's defined by these numerous gaps. So once again, we may not get all the way up there. Once you get these impulsive moves, we break out of a trading range, such as we did back in August. Typically, the dynamics change. Support levels get shattered. Sometimes they get passed right through. Bounces don't go as far as most think because remember, we're not in a bull trend anymore. And in corrections, the market often drops faster than it does when the market's going up, an uptrend. So you may not get a test of this T2 level. This may be it. We bounced actually all the way up there to 107.21, somewhere around there today, 107.28, and that's not far above yesterday's low. So either way, that's my outlook. And once again, these are near-term targets. This is a 60-minute chart. Let's just flip over to the daily chart because we've been short. TQQQ has been an official short trade idea for a while now going in. I think we put that in on the fourth quarter last year. And let's take a look at the charts. Apologize, I didn't clean this chart up, meaning I have a lot of lines on here, a lot of trend lines. This yellow trend line actually goes all the way off the 2009 lows. This is our primary bull market uptrend line, the Qs, and this is one reason among many that I remain bearish. We had an impulsive breakdown, that initial thrust up. We back tested, perfect back test of the primary uptrend line, and now we're rolling down over. And so before all said and done, and back to that TQQQ swing short trade, on the Qs, this would be the first longer term swing or trend trade. If there is a new downtrend and the market's heading much lower in the coming months, that T1 and T2 down there, T2 is 75.35. Again, I'll come in with some specific price targets as I always do later on. We're just so far away from that right now, and that's when I plan, at least as a swing trade, to tuck away for the long run and hopefully many months. So these are in levels. We're at a little support level here now on the Qs, but I put these green lines as the most likely near-term swing targets, barring any counter-trend bounces. I do think we can get some impulsive selling. Like see, we had this trading range back here where the Qs traded in that range, and there was a nice support level here. Once that broke, you can see that cascade selling. Same thing happened here. We had a trading range, and we broke down. Now look, 3 red candlesticks. We've pretty much fallen every day since then, or 4, I should say. And like I said, it wouldn't surprise me at the least by next week to see the Qs go all the way down to the $100 level. That's about another 6.5–7% drop. Although, we do have that OPEX ramp to worry about. Let's see if they try to run the market up. And as I mentioned, we have some divergences. So bottom line, and I'm not trying to be ambiguous and play both sides of things here, my bias remains bearish. But if we look, this is a 30-minute chart. You can see the what I call potential divergence. I know I use a lot of terms that might not be in the books out there, but to me, in my book, divergence is confirmed once we have the MACD, once we get a bullish crossover. In other words, you have the signal line still below, and once that blue line crosses up, it makes a bullish crossover here, officially putting in a higher low with prices making a lower low. At that point, I call that confirmed divergence. This is only potential divergence. Potential because these lines are heading lower, and they could continue lower and then negate, if you will, the divergence that's setting up. So that's where we're looking at near and short term. Once again, just to go back to the 60-minute chart, because that's where my focus is right now. These are levels, and just to be clear, it wouldn't surprise me if we fell short of these. I'm not looking for a move back up here. I can't rule it out. Like I said, we do have that potential divergence, and if that comes in and we start seeing the buyers step in here, anything's possible. So, at this point, I'm not going to say we're in no man's land, but we're sort of getting there. This was your best chance to short. When the Qs drop below this level, and as I mentioned on that back test, that was on a scale from 1 to 10, that's about a 10 as far as objective entry, because you can quantify your risk. You're shorting right before a breakdown of a well-defined trading range, and you could have shorted here with a stop, somewhat above. I don't always, as I said, I don't place my stops immediately above, because this happens. They run these stops. This is what the big boys do on Wall Street. Those with the money and the machines that can move the market. They know. A lot of retail traders, if that's the bottom of the support zone there, they're going to set their stops right on it or right above it. So that's why I always give a margin of error. Likewise, when I set profit targets, I mentioned before, this is where I have T3, the green says 105.81, but I mentioned before I would set my buy to cover orders if you were planning to cover 8 cents above that. Now, fortunately, this morning we gapped below support, and so I mentioned in pre-market that was an opportune time to cover. I think the Qs were down there around 105.50 or so. So that's what I'm looking for, and if the charts change, so will my opinion. But for now, like I said, the trend is clearly down, so you want to be in short the rips and cover the dips mode. Okay, this has been Randy Finney with the right side of the chart.